Hello, I'm Michael Hainsworth. Investing in the United States today is riskier than one might think, and for more than one reason. Wall Street has been on a tear, fueled by artificial intelligence. But the reason for the concern? Valuations of companies tangentially tied to the story may be inflated if ROI doesn't follow EPS. This is Ryan Nickel.
I think the biggest misunderstanding as it's developed over time is that people now view U.S. equities as the lowest risk. And I think, if anything, that has changed in the opposite direction. The concentration of technology and AI has gotten really high. The correlation has gotten really high. It's related to a CapEx cycle with an undetermined outcome. I would say the risk related to U.S. equities is actually higher than people think. And the risk related to other international equities is probably lower than people think at this time.
On this episode of On the Money, if artificial intelligence stumbles, what's the real implications for the broader markets? But first, here's some money insight to share with the kids tonight at the dinner table. It's ironic that when we're young, we have no interest in being old. But it's compound interest that will allow us to afford a second youth in our old age. Let's say you invest $100 a month at age 20. That's $1,200 a year. And let's predict that investment grows 7% every year. Sure, in just the first year, it's $84 more in your bank account. But now you have $1,284 to grow 7% the next year, all while still adding $100 a month. After 30 years, you'd have $121,000. Sure, that's not enough to retire on, but let's hope that between ages 20 and ages 50, you're building a career and growing that paycheck, allowing you to invest even more than $100 a month. Now, the longer you wait, the less compound interest works in your favor. Wait 10 years to age 30, and you'd have almost half the amount of money in the bank by age 50 than if you'd started at 20. And speaking as someone who is 50, trust me, you're going to want that money in the bank. The earlier you start, the harder your money works for you, quietly building a financial future that rewards patience and consistency. Whether it's for retirement or simply long-term security, embracing compounding today means turning small steps into significant leaps tomorrow. Time isn't just money, it's your most powerful financial partner. The parallels to the dot-com bubble aren't just cocktail party chatter. Artificial intelligence has driven broader market valuations to near peak levels, and much of the earnings optimism hinges on AI delivering future growth, not present profits. Portfolio manager Ryan Nickel tells me all we've seen so far is a surge in capital spending, not a surge in return on investment. The U.S. equity market has been on a, decade-long winning streak? How close are we to historic peaks?
I'd say we're pretty close to past peaks. The valuation levels we're at right now look very comparable to the late 2021 period, which obviously growth stocks were running high, and then you saw a pullback in 2022. We're starting to approach the dot-com bubble. I think the U.S. market was more at kind of 25, 26 times earnings at that point. Now we're more in the 22 to 23 times range. So we're certainly elevated. We're not at all-time highs, but we're high enough now where it's at a concerning level, I would say.
So what brought us to where we are today?
It's pretty clear, driven by the dominance of U.S. tech. It's been an incredible run for the industry. They've generated superior earnings growth. They have incredible momentum, incredible long-term growth stories. And that's led to, obviously, investor enthusiasm. That's driven the market higher. And that's kind of put it up kind of close to those prior peaks. Now, that being said, there's other parts of the market, non-tech related stocks, international markets that aren't at peaks. So it's very much a kind of U.S. centric issue.
As I understand it, about half of the U.S. index, the S&P 500, is exposed to a single driver, and that is artificial intelligence capital expenditure. If AI is as transformative as the optimists tell us it will be, should we or should we not be concerned about that concentration? Is it a strength or a risk?
That's a really excellent question. And it's a little bit to be determined. You framed it pretty correctly. The U.S. tech index is now about 35% of the U.S. market, which is at historical highs. You layer on that parts of other sectors like the the Facebooks and Googles and Amazons of the world, you're looking at 45% plus. And then you can add on to that other companies that are exposed to the AI theme within electrical equipment and utilities and power companies. You are looking at something like half the US index is now associated with the AI theme. That is problematic. If you're a Canadian investor and you go back 10 years, you were looking at probably something more like 20% of the US index was related to tech. And then you had large exposures to financials and healthcare and industrials, consumer staples and consumer discretionary. It was a great index for Canadian investors to diversify into. On top of that, the Canadian dollar was stronger, so you're buying the US exposure for cheaper. Now, with 50% exposed to a singular theme, which has some risk related to a CapEx cycle, without making any kind of statement on AI itself, just that level of concentration risk is something to be concerned about. Within AI, my main concern is, even though this is very likely to be a transformative technology, I'm not debating that whatsoever, it's not yet clear to me how that manifests into higher earnings for the broader index. There's a large number of companies whose earnings growth, the benefits they've seen so far, is very much related to just the CapEx, the build out of the infrastructure for AI, rather than the monetization of AI. So this would be the semiconductor companies, some IT hardware companies, electrical equipment, power. All the benefits they're getting is related to the construction of the capacity of AI. And it's not yet clear that the monetization, the return on invested capital, is going to be high enough to support all that. So it remains a bit of a question of, is it the CapEx build versus is it the ultimate technology and what it is 10 years from now that actually drives earnings higher? So it's a question of concentration risk and a question of where is actually the earnings growth coming from.
Yeah, I spent a lot of time talking to chief technology officers of some rather large companies that are sort of rolling out AI on a trial basis. Start small, work your way big kind of thing. The consistent question that I hear is, what's the return on investment? How much more patience do we have before we go from this is the build stage to the show me the money stage?
I think that's the right question to be asking. And the answer is we haven't hit that point yet, but when we will is a question. I think what's unique about this is that it's a CapEx spend cycle occurring within a set of companies that are incredibly strong and incredibly high quality companies with strong free cash flows. This being, the hyperscale businesses of Microsoft and Amazon and Facebook and all these businesses that are so incredibly profitable that they can endure the pain of investing in this CapEx for a long period of time before it actually becomes kind of a fundamental cash requirement issue. So really the answer is simply, as long as investors are willing to believe the growth cycle, as long as they're willing to believe that this growth will continue, that investing in this is the best for the long term of the business, this could sustain. But at a certain point in time, these are capitalist business and they have to look at the capital they're spending and say, is this making a positive return or a negative return? It's back to basic economic theory. If you spend $1 and you earn less than your cost of capital, that is value destructive. They can only push that so long. Eventually, they need to see a return on invested capital that makes them encouraged to spend the next dollar and the next dollar and so on and so on.
Is there historical precedent for this? I sort of touched on this, cross-sector correlation tied to a single sector.
There's kind of three you could kind of point to. You could point to the dot-com bubble of the 90s. You could also point to maybe slightly lesser ones, but the mobile and cloud transitions of the past 10 to 15 years. And the kind of question that we're going through is, which one is it? If it's the 1990s internet buildup, that was very much a overhyped cycle where the infrastructure spend was unnecessary. It wasn't monetized in any kind of reasonable time frame, and you saw a collapse of stock prices. If it's more of the mobile and cloud where the transition is, that the CapEx spend is more in line with the actual revenue recognition of the monetization, then these businesses can grow through it. Where we are on that that spectrum is to be determined. I would say in terms of the hype cycle, the noise around AI, it feels a lot closer to .com to me than it does mobile and cloud. But in terms of the fundamentals of the businesses, they are better today. These are occurring within high quality businesses. So on a fundamental basis, it's not kind of as scary as it would have been if you kind of look back to what it was in around the 2000 timeframe.
While the S&P 500 is near a historical high, it hasn't hit it yet. But the market is heavily concentrated in tech and companies supplying tech with the tools it needs to develop AI. So half the index is exposed to the capital expenditure needed to make the fourth wave of artificial intelligence stick. Amazon has tied consumer discretionary growth to AI. Meta's reliance on AI for ad revenue can't be underestimated. And even utilities companies are spending to support power-hungry data centers. So far, so good, right? But what are the signs the run is done? Even a buy and hold investor needs to understand the risks to the U.S. component of their portfolio. Nickel is keeping a close eye on the hyperscalers. You have said that there is over-earning in the market. What do you mean by that?
It's more potential of earning, because I don't want to make a call that like earnings are going to go down in the market. We don't know that. I would say earnings are maybe a bit more vulnerable than people think if the AI capex cycle rolls over. So many of the companies are benefiting just from the pure spending that's going into it all. Essentially, the capex going into semiconductors and into hardware and into power and electrical equipment. If you ever see that pull back, you would see actual negative revenue revisions. You would see earnings declines. And then the market as a whole is just at elevated margin structures, which historically are very, very elevated. So it's just one of those things where earnings may kind of disappoint the high expected growth that we've achieved over the past decade. The past decade of earnings growth has been quite strong. That's why stocks have been strong. They're correlated with earnings growth more than anything else. It's just potential if you see the capex cycle roll over, that earnings could be a bit more disappointing than maybe people expected.
So we haven't seen the markets reacting negatively to skyrocketing capex numbers at this point in the game.
I think it's mainly because the companies can support it for now. And until they kind of start to get more stressed or it becomes more obvious they're not generating a return, it's kind of it's a very expensive capex cycle that's being funded by very profitable businesses.
So then what signals should we be looking for to see that there's been a trigger in an AI-driven market pullback?
The most obvious indicator is if the hyperscalers like a Microsoft or Amazon say, we're not getting a return on this capital like we thought we would, and we're going to pull back. That's the obvious one. In terms of before that once you get to there, you'll kind of know that the cycle is struggling. Before that, it would just be an increasing level of discourse in the market around the return on these investments, and you'd expect that to pick up over time if it becomes more aware that maybe the ROIs on these investments is not great. On the flip side, if it becomes clear that this is all being monetized, that revenue is accelerating, that margins are holding up well, then it kind of continues. So it's a bit of a question of what is the return and how long does the capex go on for?
Right. So the ROI hasn't been proven in AI just yet. How much do you need to see to be confident that the capex spend is justified?
It comes down to kind of the math of the fundamentals in terms of revenue acceleration, the broadness of it. Do margins hold up? Again, with acceleration in capex, you also get an acceleration in depreciation. So in theory, you need to accelerate growth or find cost savings elsewhere to maintain those margins. If it becomes clear that at the new kind of elevated capex levels, these businesses can sustain high revenue growth and sustain margins, it's really more just a time of proving that the numbers make sense. And so over the passage of time, if revenue and margins hold up, then it'll become more and more obvious that this was rational investment of capital.
Okay, I think I get it. If spending is unsustainably high for companies supplying AI with what it needs, earnings per share will drop when spending normalizes. There's the canary in the coal mine for AI. If Microsoft, Amazon, and Google start softening their language or fail to show returns on their AI investments, sentiment could turn quickly. So where do we go? Nickel likes Europe, and not just because he's come back from a vacation. We need to invest where it's easier to find value. And for investors with cash to deploy, there's one sector Nickel tells me is out of favor, and that makes it cheap. But let's not get ahead of ourselves. So if the S&P 500 is a bit of a minefield, where do we plant a flag without it blowing up on us?
I think the answer for this, as it always is in investing to a degree, is just diversification. There's a very specific kind of concern that I have. It's around just the concentration of US stocks and the correlation to a known capex cycle. But it's fairly easy, particularly as a Canadian investor and as a global investor, to find other opportunities. I would say within the US market itself, there's a lot of opportunities just outside of the tech room. So in defensive sectors like healthcare, consumer staples, real estate, things of that nature. And then there's opportunities internationally. I would highlight Europe as a particularly interesting one. It's a cheap market that has a lot of improving fundamentals. So it's maybe a bit of a boring answer, but the simple answer is almost always diversification. If 50% of the US market is correlated to one theme, I would say make it less, make it 25%, make it 20%, just diversify to other areas of the market that are cheaper and less risky.
Okay, so then what is your weighting on Europe and where particularly? I'm thinking that if the AI hype fades and the US market corrects, does Europe look better, or does the advantage also evaporate? Rising tide lifts all boats, but it can sink them too.
I think Europe, no doubt, outperforms in that scenario. So we are pretty far overweight. Europe, the funds I run are about 36% Europe, which is basically double the MSCI World Index's Europe weight at this point in time. We do skew generally to more defensive businesses, and that's certainly true within Europe. So we have a bit of more dramatic overweight in UK. That's not really anything intentional. That's just where high quality global defensive businesses happen to be located. But our European exposure is very broad. It's in defensive healthcare and staples and utilities and infrastructure companies. It's also in financials and discretionary and industrials and technology. So it's a broad-based exposure, and it comes down to a number of factors that are largely not related to AI. They're just related to fundamentals, and that the stocks there are just cheaper. It's pretty straightforward, and they're high quality. So the US index trades at something like 22 and a half times PE. The European index is about 14 and a half. That's 8 terms of price earnings multiple. That's a lot. That's historically high. And on top of that, I think Europe is improving. It's pretty clear that the banking system has stabilized. The businesses are growing. The loan growth is growing. They're not high growth, but they're stable and improved and less risky than they were. The countries themselves are starting to actually kind of loosen the purse strings a bit. They're going through rearmament. They're going through infrastructure investment, and they're in good financial positions. They didn't spend the last 10 to 15 years in the same way the US did with huge budget deficits. So their debt levels are much more sustainable. So if they're going to go down that path of being a little bit more spend on the fiscal side, like they actually have the capacity to do it. And you layer on top of that, if there's any kind of new inflow of cheap Russian gas, if there's any improvement in emerging markets due to the weak US dollar, that all impacts Europe positively. So you could see a case, absent kind of an AI boom that drives US earnings higher, there's a case to be made that European earnings growth could be as good or better than US earnings growth over the next 5 years. And if you layer on top of that the starting point of a much cheaper valuation, that's how you would get a turn in the cycle the past 10 to 15 years towards Europe. So it's one of those kind of, it's easy to say diversify. It's easier to diversify when there are other options that look relatively cheaper and lower risk. And I think that's a scenario we find ourselves in today.
I want to come back to something you touched on a moment ago, healthcare particularly, as a sector that's out of favor right now. Why is it out of favor? And is this a buy for a long-term buy and hold investor?
The reasons why it's out of favor are probably too complicated to lay out in a shorter podcast. I could go on for an hour or so on that. I would say it's multivariate. Obviously, there's a number of factors. The first on drug pricing, there's obviously a lot of U.S. government focus on that at the moment, trying to normalize U.S. prices down to international prices. That puts pressure on the pharma companies. There's pressure on the U.S. healthcare insurance companies because utilization has spiked both post-COVID and as people fear losing their benefits. There's been declines in research spending, which has impacted the tools companies. So it's kind of sector by sector. There's been fundamental issues within healthcare. But on top of that is more just the day-to-day movements of the market. Is if everyone's going out and buying tech and AI stocks, the source of funds has to come from somewhere else. So I think the sentiment on healthcare is very, very negative, similar to where it is in consumer staples and other defensives, but even more dramatic because of all the fundamental issues I laid out before. Having said that, we are at a level now that I haven't seen in healthcare. The sector is as cheap relatively as it's been. It's even worse than the Hillary kind of tweet leading up to the 2016 election. It's probably comparable to the 2010 Affordable Care Act revisions. Before that, you're going back to the early 90s. This is the cheapest the healthcare sector has been in over a decade. And I would make the argument that the fundamentals are not as bad as maybe as with the market and people think. I think for each subsector, you can make a case that drug pricing is probably not going to be as impaired as people are pricing in right now. You can make a case that the insurers are going to reprice their plans and see margins rebuild over time. You can make a case that the tools are going to rebound on just a normalization of research spending. And you layer on cheap starting valuations and a sector that is both secular, growing, and defensive. This hasn't changed, but people are still getting older. You still have an aging demographic, and that drives higher healthcare spending. It's still a defensive sector. People continue to utilize healthcare services even in recessions. So it's a defensive sector that's very cheap and perhaps a bit underappreciated right now. So for us, that's a place that we're happy to add additional capital to it.
I see, though, that you're underweight on Asia. What's the challenge there?
That one's not specifically because of any kind of thoughts on the investability of Asia. It's just difficulty in finding unique ideas. So we are focused primarily on developed Asia. So that would be primarily Japan, a little bit of Singapore, Hong Kong, Taiwan, and Australia are kind of the primary markets. Australia, we don't really focus on because it is kind of a pro-cyclical economy like Canada. A lot of materials exposure, the currency is volatile. It's not really something that we think is, diversifying for Canadian investors in a really positive way. In Japan, the issue is more that we struggle to find ideas that are both quality and value. So Japan has struggled with growth for a number of years, but there are specific companies that have outperformed, achieved higher growth, and those have been richly rewarded in the local market. So a lot of the highest quality, best growth businesses there are quite expensive. And then there's a large number of businesses that are more domestic, much slower growth, kind of, they've been called zombie businesses, but essentially businesses that are just exist and don't really grow. They're very, very cheap. So there's a lot of value there, but they don't really match our definition of quality and growth that we're kind of looking for. So it's mostly just been the difficulty in finding individual ideas rather than any kind of view on the broader investability of Asia.
So what's the biggest single misunderstanding that investors have today about the investing environment?
I think the biggest misunderstanding as it's developed over time is that people now view U.S. equities as the lowest risk. And I think, if anything, that has changed in the opposite direction. The concentration of technology and AI has gotten really high. The correlation has gotten really high. It's related to a CapEx cycle with an undetermined outcome. I would say the risk related to U.S. equities is actually higher than people think. And the risk related to other international equities is probably lower than people think at this time.
All right, Ryan, for the record, were any of these answers provided to you by ChatGPT or any other AI?
They are absolutely not, although I do have access to it. I could have used it, but I have not.
Ryan, great speaking with you today. Thank you for your time and your insight.
My pleasure.
Nickel still sees U.S. equities as the safest place for long-term capital. It's the risk profile that's now changed. It's now concentrated. It's a bet on the future that's far from guaranteed. And the smart money is redeploying gains to cheaper areas of the global investment landscape, like European defensive stocks, tied to consumer staples, steady global compounders, the ones focused on emerging markets where the AI spotlight is not shining. And for the record, no artificial intelligence was used to create this content. For better or for worse, I've had to rely on my own intelligence for this conversation. So thank you for your patience. I'm Michael Ainsworth. Thank you for joining us.